Professor, you're on mute.
Oh, I'm sorry. I've been talking all this time, and so you can hear me now, right? Can you hear
Yeah,
me?
now you can. Yeah.
Okay, okay, great, great. I've been muted all this time, and Tyra just dropped into the chat box that I don't see no items. Actually, I see no items, or I don't see any items in the discussion board. You got bored already? Bored, right? That's the board, discussion board. So yeah, I found it weird because as before I came into okay today's lecture. Don't you see this forum? Uh,
No, we cannot see today's forum.
No, we don't see it.
Forum is not available. Why? Oh, something's not. Ugh. Okay, I'm sorry. That was like PM. That should have been AM. Somehow I set the. Alrighty, there should 9:30 AM. All right. So, oh no, that's 6:30. My eyes are, not. Okay, 9:30 a.m. So you should be able to see it now. Try it again. Somehow 9:30 p.m. was, selected previously. You see it now?
Yeah, now it's good.
All righty. Now you please go to today's forum and please report attendance there, because that's the only way you can leave your physical record of attendance. And I want to, okay, so in our last class, the example of balance sheet that I used was a very kind of simplified version, truncated version, right? Truncated. So I would like to. So I added another. I mean, this is not in the file, right? This is not in the file that you downloaded, but this is. So just for illustration, I simply added this one for for better illustration. So in this balance sheet, I broke it up into two sections. First the asset side, and then the liabilities and equity side. Okay, so everybody can see this, right? I'm sharing my screen, so you should be able to see this, right? Alrighty, and I have this is 10 people, should be 11 because I see 12 here. Yeah, 11. All right, and where was I? Now, some people ask me by email, what is the miscellaneous adjustment or miscellaneous items, or it's got many names: miscellaneous adjustment, or I just don't want to miscellaneous assets and miscellaneous liabilities. Some people were asking me what are those. It goes by many different other names, so I can comment. It goes by also other assets or adjustment. So it's got, it has many names. Also, so you should be able to recognize it no matter what it goes by. The thing is, the reason for that, first of all, filling in the blank in the balance sheet isn't a difficult thing, because all you need to do is, well, this is total current assets. So total current assets, there are more line items. Let's say, I mean, just to make it a full scale one, right? Let's make it a full scale one. Stocks and bonds. And then let's make it, and then accounts receivable, and accounts, let's say promissory notes. Oh, what did I do? Did I delete?
Wait, Professor, I have a question regarding the
Yeah.
homework. Isn't the homework due tonight?
Yeah.
Okay.
Tonight.
Because I seen something that said it was due yesterday, but I know it said it was due today.
Yeah. It's due 11:59, so it's not too late. So let's say we have 24. That's a lot. That's just whatever it may be. And promissory notes, let's say 125. Okay, if this is the case. So I made it, more full, fully fledged, more, more realistic balance sheet. So finding total assets is not a difficult thing. All you need to do is using auto sum, and it will find the total, right? And also the total non-current assets, or I separated land and building. Oh, good, and plant and equipment. Okay, good. And depreciation is the depreciation applies only to building, plant, and equipment. Okay, land doesn't depreciate. Anyway, so the value of building, plant, and equipment went down by 20,500. And this is already negative, right? Because it's the decrease in value, it must be subtracted. But it's already in negative number, right? In Excel, in spreadsheet, negative numbers can be expressed as red font, or parentheses, or with a minus sign, right? So either way, we know this is already, negative, so we don't have to subtract it. If we add them up all together, it will be automatically subtracted, right? So all I need to do is, again, using auto sum, okay? And then, since I want you to do this together with me, I would like to, oh, no, I'm sorry. What did I do there? What did I do? I should have done it here. And I want you to do this together So let me upload this file. Okay, let me upload this file, just this one, so you can add it. Okay, or maybe I can. No, I will just upload a separate one. Or I will upload the whole thing again. Then let's do this. Okay, I gotta go topic 1. I think the file name was like that. Okay, so the file was updated, right? It's the same file, but it's a new file. Can you go to the topics folder and download it now? Can you download it? And once you are downloaded, once you have downloaded an open file, then you will see this is the second worksheet, right? It just says sheet number 1. Okay. So everyone has downloaded. Let me know. Let me know if you guys are ready. There are 11 people. Oh, how come only 11 people? Still, so Asietu, were you able to download it?
I'm having trouble finding it.
What do you mean you have trouble?
It's a new name. I'm sorry. The new name is a financial statement X, right?
Yeah.
Correct. Okay, I got it.
That's yeah. And it's the old name. I mean the file name hasn't changed. I just I just uploaded a new file
So
under the
it's
same name.
financial statement EX.
Yeah.
Correct. I was
Okay.
able to upload it.
That EX means example or Excel.
I see.
Excel example. They both are EX, right?
Right.
So everyone found it. Everyone has downloaded it. How about Anna? Have you downloaded it? Were you able to download it, Anna?
I was able
Anna,
to. Also.
Jonathan?
Yeah, I was able to.
Okay, you did it. You got it. And Ethan, did you download it?
Yes.
Okay, Janik? Okay, Janik, did you download it?
Yeah, I was able to download it.
Okay, Janeth?
Yes, I did.
Did you download it?
Yes.
Okay, and Kula, did you download it? Kula, are you there? Okay, Mariana, did you download it, Mariana? Mariana, are you there? Richard, were you able to download it?
Yeah, I was able to download it.
Good. Tyra, did you download it? Tyra, are you there?
Yeah, I downloaded it.
Okay, good. Yanchu, did you download it, Yanchu?
Yes, I am.
Okay, Good, good, good. Anna, your microphone is off. Okay. All right. So if you have downloaded it, then did you find? Did you open? Did you find this worksheet? It's labeled, sheet 1.
Yeah.
Okay. So I'm sure you're right on that page, right?
Mm-hmm.
So now, total current assets and total non-current assets are already found because I already filled it in. So next is, you might think the next is finding the total assets, but don't jump into that just yet. Let's first, find in this column C, right? Column C. Let's just put right next to B19. So in C19, because just tentatively, let's find the total assets there. And of course, we can use the sum command because it's the sum of these two numbers, right? It should be the sum of these two numbers, right? And then I say, it's just, hashtag. No, it's just because, the column is not wide enough. So what I want you to do is just bring the cursor to the borderline and then double click on that, and it's going to expand automatically. And this is just tentative total assets. The thing is, this is a balance sheet, which means asset side and liability side must balance out. Okay? Asset side and liability side must balance out. So what if we just, if you enter this into total assets, and what if total liabilities and equity don't balance out with the total assets? Of course, then you're in trouble, right? You have to find the source of the discrepancy, and you have to eliminate the discrepancy. That's what you need to do. But what if this is a minor discrepancy, very, very, a minor discrepancy, and you have done, you have scrutinized your data, you have scrutinized everything, but you haven't found the source of the discrepancy. If everything is up to date, all the data are up to date, but still you can't reconcile the discrepancy, and if the discrepancy is a very small one, a very, very small one, then what do? It's called, statistical adjustment. You can use, statistical adjustment, which is called which goes by different names, miscellaneous assets, other assets, or statistical adjustment. Meaning, there was some statistical error, minor error in the data collection. During the process of data collection, it could have been a nothing significant, but it's just nothing significant. Data has not been updated, or once the data is updated, then it can be that difference can be reconciled. But for now, so that we can have a balanced total asset and liabilities and equity side, we will have to use miscellaneous assets. So you can also, another way, of course, you can simply add this. If you don't want to use sum command, you can do this. It's the same thing, of course. It will be the same thing. And we will, so tentatively, this is the total assets. And let's find the total liabilities, right? The other side, right? Accounts payable, notes payable, salaries. It's actually, the better term is accrued wages. Why is it 851? Oh, I put it somewhere like this. Okay, so it's accrued wages. But, let's leave it like that because, accrued. It's not taxes, but rather accrued taxes. So I gotta. Of course, finding the sum of all of these line items, as long as they are already as long as they are from compiled data, right? Then these data points are already entered there. Of course, somebody has to enter it there, but either you or someone who works as your assistant must have entered the data. Then all you need to do is find just some and then also mortgages, mortgage and bonds payable. Those are our non-current assets. Finding non-current assets also nothing difficult. And then total liabilities are sum of these two numbers, right? Sum of these two numbers. Here you go. And then our equity is this. So our total liabilities and equity will be then sum of these two numbers. Okay. But just tentatively, I will just put it there. And normally you don't want to show this to. This is just for your own eyes, right? You don't want to show this to other people. It's because it's just for your own reference. Let me unify. I will just unify the font. Okay, so most of the times you will simply hide it, like by collapsing the column. I guess 2 will be good. Column with any column with that. If the column is collapsed, then it's not going to show. Okay, then, but right now we can tell total liabilities and equity don't match, so you're in trouble. If this is the case, you're in trouble. So you got to find what is the source of the discrepancy, and you have to close the gap. You got to reconcile the differences. But then, as I said, in the meantime, if this discrepancy is minimal, just due to some statistical error, what you can do is this side will need to be adjusted because this side is greater, so there is something that should be added to this side. And of course, you can say, oh, then isn't it simple? I can just I can do this, right? This is not very minimal. I mean, this is not a insignificant difference, but just assume that this is a very minimal, insignificant difference. Yeah, but you can do it like that by visually checking. But then that makes your life more. That makes your life more complicated. In other words, you have to visually check everything, and you have to make your this discretionary judgment. You have to make your discretionary decision to fill the gap. But we can automate all this process, right? We can automate all this process because sometimes this side may be smaller, sometimes the asset side may be smaller, sometimes liability side may be smaller. You might wonder, can you not subtract the difference from this side? Can you not subtract the difference from this side? No. Look, it's your asset, right? Unless it is due to depreciation, right? Your assets deduction or reduction in your assets, there should be a significant. There should be a really plausible explanation for that. On the other hand, this side increasing is not a big deal. Why? Because this side is the source of the fund, right? Source of the capital. So let's say about $100,000 were added here. That means that $100,000 is supporting some assets here, right? $100,000 debt is supporting some assets here. Maybe though that $100,000 were part of this building and land, but that wasn't the data was not updated or something, right? So the point is, if we have $8.9 million worth of total assets, it's either in plant and equipment or building and land. It's held or in current assets. No matter no matter what it may be, it's held in the form of either physical assets or liquid assets, right? So no justification is needed for having $8.9 million held in these assets, and explaining that by let's say 8.9 million is held in the asset, but our total liabilities and equity is slightly below that, and then it's due to some statistical adjustment, it's statistical error, or so the adjustment will be made later. Okay, so that's why I'm saying it should be a very minor discrepancy. If it is not, if it is a major discrepancy, you can't do this. You have to really account for the source of the discrepancy. Okay, so as I said, sometimes this side needs to be adjusted. Sometimes this side needs to be adjusted. So I want to automate that process without your intervention, right? Without your personal intervention. I want this balance sheet to automatically adjust itself. How? By using an if command. So this is, an if command will come in very handy. In many cases, if command will take care of everything. It can do a lot of things. I use if command in almost, everything that I do, and that automatically takes care of even, whenever there is a comparison that needs to be made. This is something, that works like a, it works like a magic. I don't want to use the word magic, but it works, immaculately. It works immaculate, like an immaculate machine. Of course, it's, because it's a mechanism. So start with all functions start with equal sign. All formulas start with equal sign. So the miscellaneous adjustment that needs to be made is equal to, start with if, and you open parenthesis, if, and if this cell, if this thing is greater than this thing, right? You can just click it in, and if you cannot click it in, you'll just type in, right? So if this side is greater than this side, comma means and, then there is something to do. What do you need to do? You will need to take the difference between the two, right? What goes in that cell, what goes in that B19 is the difference between, and because if this meets that condition, if C21 is greater than G21 is greater than C19, you take the difference between the two. Okay, because of that, formula thing, that I cannot type it, click it in, so then I will type it in, C19. Okay, comma, second comma means otherwise, right? So I will put, normally, this doesn't matter, but I will put a small space, just one, space tab, and then one space tab. Otherwise, do nothing. Leave it as 0, right? Or 0 or do nothing. If you leave it blank, it will do nothing. But enter 0, because think about it. If this side is greater than this side, then there is something to do. You have to fill this in by the difference between the two. But if that's not it, then you just leave it blank or enter 0, right? And close parenthesis. Then Excel will exactly execute that. Hit enter, blank, right? Now here, then we apply the counter logic here, counterpart logic. So the work that needs to be done applies only when the other side is greater than this side. So if this side is greater than this side, which is G21, then we do the same thing. In case this side is greater than this side, we take the difference between the two, right? Otherwise, just blank or 0. And it's going to automatically, oops, what happened? G, then is C19 minus G21. 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 Otherwise, 0. And it automatically finds, right? That automatically finds the difference. So this way, it can be automatically handled. All you need to do is, when in Excel is not for just entering data. I mean, when you enter data, you got to do something with the data, right? Some people use enter all these numbers, and then I've seen the students doing a senseless thing, like they have all this data, and then for total current assets, then on the paper or using the paper, they add write these numbers and then add those numbers, or use calculator to add those numbers and enter that number here. And what a senseless thing that is. You have all these data points, and all you need to do is just add them up here, on Excel. Why do it somewhere else? And then just copy the number into. They think, and I saw a student who was, in accounting class and doing that. The assignment, she was like a what do you call that? Work study student. So she was working in the department, doing the assisting the secretary, and then she asked me, she was doing the homework from accounting class, and it was like, it was a spreadsheet, and there was data, and all data points. The assignment was, just like this. The data, initial input data were given, and then she need to fill in the blanks, and she was, adding up the numbers on the paper and then copying the number into Excel. And that was really, really, a senseless thing. I told her, why don't you just add them up on Excel? And she had no idea she could do that. But somehow I don't understand why in accounting class they don't even, they give homeworks in Excel, and they don't wonder, why they don't teach, how to use the basic functions of Excel, even the basic functions, if not, more. But anyway, this way it can be automated. And then all you need to do is now, for total assets, you'll just sum these three numbers, right? Comma means always and, right? You know what Oxford comma is? It means and. And here, of course, there's no difference, but then it will make a difference here. So there's total liabilities and equity, and then equity, total liability and equity, and then miscellaneous liabilities. And then what? Now they are balanced out, right? And then you don't want to show this to other people because it's just for your own reference. Okay. You can just collapse the column. Now everything is, neat. Okay. So everyone is okay with this? Have you done this? Were you doing this as I was demonstrating it?
I did. I used the same way for the homework.
Okay, good. You did it in the same way in the homework.
Yeah.
Great. All right, great. So that basically wraps up. At this point, it doesn't wrap up everything about the financial statements, but for this juncture, right? At this juncture, the first part of financial statements are all done. So now we want to move on to taxes, right? Taxes, and of course there are a couple of things I have to. A couple of things. Was it this? No. This is not the one. Because some minor line items that that wasn't discussed previously. But where do I? Let's see. Cash. Okay, this one. All right. All right. So before we move on to tax, right? Tax. in the accounts receivable, right? Of course, that's the concept, but I told you, the physical form of accounts receivable is invoice, right? And invoice and promissory notes. I need to talk about factoring, but those are the already last week's and this week's main lecture videos. In the main lecture video, it's clearly explained what factoring is and why it is called factoring. But in the accounts receivable, we need to have a little bit of bad debt reserve, right? Because some of the accounts receivable may not be collected at all. It may never be collected. So some of it needs to be bad debt reserve, right? And then when these are not collected, then you'll have to write it off, right? Okay. And then and we talked about the types of inventory, because inventory now in the main lecture videos I made it very clear. Inventory for manufacturer and inventory for retailer will be different, because manufacturing will have raw material. First of all, they start with the raw material, right? Raw material, and then goods in process, because raw material goes into the into production process, into the machine, right? Production equipment, and at the other end of the production process comes out the finished goods. So the manufacturer's inventory consists of three types: raw material, goods in process, and or goods in process or work in progress, right? They mean the same thing. And then finally, finished goods. And most manufacturers don't want to hold on to finished goods for too long, because first of all, as I told you, it costs them warehousing. It's broadly categorized as inventory ordering cost and inventory carrying cost. Now, ordering inventory costs money, because every time when you order inventory, right, and for a manufacturer it will be raw material, right? The shipping, the cost of shipping, and some transaction cost. All this is, inventory ordering cost, and then inventory carrying cost. You need to warehouse it somewhere, right? And you might say, doesn't the plant have warehouse of their own? Yeah, if you're a manufacturer, you would have a warehouse. But then think about it: having a warehouse and maintaining a warehouse incurs an opportunity cost for you, right? Why? Suppose you don't have any raw material to put in there. That space wasn't needed in the first place, right? That warehousing space wasn't needed. And if you have, a warehouse is usually not a very sophisticated structure. It's usually, what do you call that? Tin. Usually, they can build it with a container, right? A shipping container, or they can build it with, some basic steel structure with the tin foil. But then even then, you have to buy a land for that, a piece of land for that, and you have to have the racks for, and also you have to have a security guard. You have to guard it, because if this is a expensive raw material, right? The theft, right? There is a possibility of theft. So, or fire, right? Damage due to fire or flooding, right? So all of this is part of the inventory carrying cost. And so you will have an insurance in case of, to insure against fire, theft, pilferage, theft, a flood, all kinds of situations. That's the inventory carrying cost. And as for the finished goods too, and if you didn't have this inventory cost, if you didn't have this warehouse, then there would be no such cost, right? And if you have, but you already have a warehouse, but then there is nothing in the warehouse. While there is nothing in the warehouse, you could even rent it out. If there is nothing in the warehouse, you could rent it out, and that could generate income for you. But you cannot easily rent it out because you don't know how long this, warehouse is being idled. How much longer it will be idle. I mean, if you know exactly for 2 months it will be idle, you can even rent it out for 2 months. But your raw material is coming in constantly, and your finished goods are coming out constantly. You can't even do that. So the best thing is, of course, as for your finished goods, you will have to keep it, warehouse it for some time until it gets shipped out. But the point is, if you can minimize on the warehousing space, right? If you can minimize on both inventory ordering cost and inventory carrying cost, that will be the best, right? But anyway, in the inventory, right, you have to also have some inventory reserve. And then you need to have, you will need to write off if some inventory turned bad, right? Some inventory is usually unusable. Inventory balances are reported net of the reserve. Yes. And then when some inventory gets spoiled, then you write it off. So always, and those two line items will have to match, right? But I didn't put it in here in the example because you can't go too much into detail. But this is already quite fully fledged. I mean, it's not 100% fully fledged, but this is pretty much very detailed. Okay, that pretty much sums up everything. So now let's move on to tax. Oops. As for the accrual, I explained it in detail in also the main lecture videos. Working capital is another name for current assets. Probably in the last class, I called this operating capital. You can call it operating capital, but working capital is the correct term. And leverage means debt. Debt is called leverage, and you don't understand actually. At this point, you don't see why it is called leverage, but as we go into the capital structure, if you go into the capital structure, and moreover into the as we go into the stock valuation. I mean, in this course, we don't go into stock valuation. It's just assume that because you have learned the stock valuation in Finance 100, it is assumed that you already know, you understand the stock valuation formulas and the mechanism, the mechanism that is linking the debt. So that should be, through the capital structure. The mechanism that is linking the valuation and the earnings per share, right? The resulting earnings per share and the leverage, the connection between the leverage and the, in other words, debt and the earnings per share. So the reason the debt is called leverage is boosting. The debt is like a lever and fulcrum, like a lever and fulcrum. It will be boosting. There's a leverage that is gained by having debt. So boost in earnings per share. So and this is, basically, common stock is the basis of all, of equity, of course. And the common stock, for example, as the company sells common stock, right? Company sells common stock basically for the first time at IPO. And everyone understands what IPO is, initial public offering, right? So that's the first time that the company goes public, meaning they get listed in the stock market and selling stocks for the first time to the stock market, so to the individual investors. And IPO is called primary market. And after that, everything is secondary. Every transaction is secondary market. So think about it. At IPO, the stock transfers from the company to the first round of buyers, right? First round of buyers. And that price, when they first sell, that's called IPO price. So IPO price is basically the price of the stock in the primary market. And after that, stock just changes hands between investors, right? So transferring stocks from the company to the public, right? It happens only once, right? And it's called the primary market. And after that, and that's IPO. And after that, stocks change only between investors, right? So if I bought the stock at IPO for, in this example, $2 for $2, right? Actually, let's say, dollars, right? $6. Where was I? So I paid, IPO price was, $6. So I paid $6, and I bought, let's say, 2,000 shares, and then I'm holding on to it for like 2 weeks, and within those 2 weeks, the price went up to $10, right? So I think I've had it enough. I mean, I've I made $4 gain for each share. So and I think it's not gonna go up as much from now on. It's gonna this is the highest point. I'm near the highest point, or sooner or later there's gonna be a turnaround. So I mean, if that's what I believe, then I will sell, right? And then whoever buys from me, that's the second round of transaction, right? It's the second round of transaction. That's called the secondary market. So this guy pays $10 and buys the shares from me, like 2,000 shares from me, and he's holding it until he sells, right? And he may, the price may still continue to go up or may drop, but whenever he sells, the third guy who buys it, that's the third round of transaction, but it's not called, oh, then is it called tertiary market? No, it's all secondary market. After the primary market, no matter how many rounds of transaction happened, it's all called secondary market. Okay, so, and you might wonder, so after IPO, doesn't the company sell stocks again? No, they generally don't sell stocks. They don't sell another round of stocks, another issue of stocks anytime soon. Maybe a couple of years later, 10 years later, when they are sure, right, that if they issue another 1 million shares, and if the shares will sell, if they think the shares will still sell at the market price, then they will. But the point is, they don't sell new shares anytime soon. Why? Think about it. If the stock price is $60 now, $6 now, stock price $6 now, and there are 20,000 stocks, 20,000 shares outstanding, the stockholders don't want the price to go down. But think about it. If 20,000 shares were the total demand for this stock in the market, right? So in other words, whoever wanted to hold this stock, everyone held this stock. Everyone who wanted to buy this stock bought this stock. So all 20,000 shares were all exhausted. Unless there is pent-up demand for this stock, the price won't go. The price won't go up drastically. I mean, if there's a pent-up demand, there's there's a demand, very strong demand for another 20,000 shares. Then you can still issue another 20,000 shares and sell it at $6. But if that's not the case, suppose they sell another 20,000 shares and there was no demand. What's going to happen to the price of the stock?
It's gonna fall dramatically.
Yes, it's going to fall dramatically. Yeah. Who gave me that answer? Who was that?
Jonathan.
Say that again. I'm sorry.
Jonathan Mema.
Mema. Okay. Jonathan Mema. Okay. Jonathan, I'll give you 0.25 for that. Today is 25, right? 0925, and this is fnb 230. Yeah, that's the thing. I mean, if there is no demand, the stock price will suffer, and the existing shareholders, will they like it or not?
They be horrible because they lose
Yeah, it
money.
will be horrible for the existing shareholders. They don't like that, right? So, and the shareholders are the owners of the company, right? I mean, if you just bought like, 100 shares, I mean, this is a very simplified example, only 20,000 shares, but usually there will be like, 20 million shares sold, or 200 million shares, outstanding. I mean, some of them are majority shareholders. Majority shareholders, like, holding, 15% of shares outstanding. Majority shareholders, or some of them 5%, some of them 6%, some of them 11%. Still, they will become directors, right? In the board of directors. And the board of directors, board of directors elect chairperson. So most likely the chairperson will be the one who's wielding the majority shares. And the supermajority is always 51%, right? Supermajority is always 51%. So if the majority shareholder, the largest majority shareholder, bands together with the remaining majority shareholders and they all reach 51% supermajority, then they can do anything about this company, right? Because they are owners. And I've been telling, I believe I told you this, in the last class. The management is actually hired, right, by the board of directors, by the shareholders, right? Board of directors represent shareholders. So the main job of the board of directors is to hire and fire management, right? And if the management is maximizing the shareholder wealth, shareholder value, then they will keep them on the management. If they don't do that, they will fire the management and hire new management, right? That's basically, how it is. In modern corporation, the ownership and the management are separate, and ownership is wielding the axe, right? The ownership is wielding the axe above the head of the management. Of course, sometimes the majority shareholders appoint themselves to the top management, CEO, CFO, or I mean, other than some technical functions that, like CIO, Chief Information Officer, or what, Chief Technology Officer, or other than that, or CFO, Chief Financial Officer. CEO is sometimes, the chairperson doubles as CEO sometimes. In case, the chairperson is the most experienced and most knowledgeable and most experienced person in the industry, then the chairperson can double as CEO. And as long as you can muster, you can gather, as long as you can gather 51%, then you can do that. You can, Steve Jobs was chair as well as, CEO of Apple until like mid 1990s. Then, the board fired him as CEO, but he was still, a majority shareholder. Bill Gates was also CEO, chair and CEO at the same time for a long time, until like, early 2000s when, Robert, I forgot his name, Robert something, his last name. I forgot his last name. Bill Gates stepped down as CEO, but he was still the chairperson of Microsoft board of directors. But Robert something was whatever his last name was. Robert was CEO until like 2018 or 2017. So anyway, the idea is, so this is like, par value of the common stock, par value, so in other words, if the stock was, before IPO, they determined, determining the book value of the common stock is totally, arbitrary. And then, so they determine, and it's also with the it's not the company that makes this decision. It's mainly the investment bank that makes this decision, because the investment bank is the one who facilitates this, or facilitates or brokers this IPO, and the investment bank must have set this par value at $2. But then when it hit the market at IPO, the price went to $6. By the closing of the day, right? Closing of the trading on that day, the closing price must have been $6. Anyway, so it must have reached $8. It must have reached $8 because it's in excess, right? So par value was 2. What was paid in excess was 6. So, and 20,000 shares was sold, right? So so the total will be 160,000, right? 160,000. And the retained earnings, company earns, okay. This is, basically $70,000 is then what? $70,000 is the EAT, right? Net profit. From the net profit, they paid out the dividends of 15,000, right? So the total, so the retained earnings will be 55,000. You add them up, and the total equity is 215,000. Okay, this is you remember, this is I told you this is paid in capital. Okay, this is paid in capital. In other words, the investors paid in, right? The investors paid in this. And then retained earnings is internally generated capital, internally generated equity generated from the operating activity, right? And I told you it belongs to the owners, so that's equity. In the nature of capital, it's called capital components. When we say, think about it, there's only 2 types of capital, either debt or equity, right? Those types, capital types, also known as capital components. Or capital type or capital components, or nature of capital. I mean, in terms of nature of capital, right? It is equity, right? Net profit is equity because it belongs to the owners. Okay. Dividend is also equity, but it was paid out to the shareholders, so it's not retained within the company. So what is retained within the company is only the retained earnings and the paid in capital. and so the total equity will be this. Okay, that makes sense. And this explains, the relationship between the net income or net profit and the retained earnings. Okay. So beginning equity plus EAT is, of course, ending equity. So I've been telling you, we use, two balance sheets and one income statement, right? Two balance sheets mean, balance sheet at time 0 and balance sheet at time 1. And income statement is always income statement at time 1. So balance sheet at the beginning, balance sheet at the end, right? Income statement is always as of the end of that operating period, right? Which is usually a quarterly. But when you sum all those quarterly at the end of those 4 quarters, then there's annual, right? So equity at time 0, I can write it as equity at time 0, EAT at time 1, and then that's equity at time 1, ending equity. Dividends are paid. You'll have to subtract dividend, and that's ending equity. If new stocks are sold, beginning equity plus ending EAT minus dividend plus new paid in capital, and that will be ending equity. Okay. And one thing we need to make a clear distinction between capital and total capital and total asset. We all know total. So maybe I need. I'll just put it here because the whiteboard is sometimes very difficult to use. So I'm gonna. So everyone understands that total assets is total debt, total liabilities and equity, plus equity, and sometimes assets and capital sound like the same thing, because think about it. Real assets or physical assets or fixed assets or non-current assets, they all mean the same thing, isn't that right? They are physical capital, aren't they? Because they are building and they are basically plant and equipment, and land and building, right? So focus on the plant and equipment. They are really physical capital. Physical assets are physical capital because what is the definition of capital? Capital is something that serves to produce something, right? In other words, means of production. Means of production is capital, right? Means of production. So that's the meaning of capital in a broad sense, in a broad context, especially in economics context. And money capital or financial capital is only a small part of capital because, of course, think about it. Financial capital is means of production because if you invest it, right, it gives you return, right? Of course, financial capital is invested into like physical capital, like plant and equipment, right? If you invest in some company, right, they use that money, right, to buy new equipment or conduct R&D or develop a new product so that their profit goes up, and the profit is reflected in the stock price. So you recoup the stock that profit when you sell, right, the stocks. So asset sounds like capital, the same thing as capital. No, it's different, because total capital, right? When we say capital, it only refers to the long-term capital. So it's not total debt. It only means long-term debt. Okay, long-term debt plus equity. Okay, so in other words, what that means is between capital and total capital and total asset, the difference is it doesn't include current liabilities, right? It doesn't include current liabilities. So let me. This is not capital, okay? This is not capital. Capital means, only this. That's capital. K for capital, okay? All righty. So and this distinction is important, because later you will see when we do ratio analysis, then it makes a difference. You will see. Now we're going to talk about taxes, but it's 10:53, and I think this is a good time to take a break. It's 10:53, so let's reconvene at 11. No, it's not even 10 minutes then. No, it's unfair. 11:05. Let's reconvene at 11:05. Okay? All righty. All right, we're back. We're back. So now let's get back to, let's go to our file, Excel file, and then if you look at the bottom tab, right? If you look at the bottom tab, you will see taxes. Okay, everyone sees that? Everyone found that? Let me know. Everyone has found it? I would have to assume everyone has found it. Let's see. Asiatu, I'm sorry. Asetu, have you found it?
Yeah.
Okay. Andres, have you found it? Andres? Ethan,
Yes,
Ethan?
sir.
Yeah,
Yes,
yeah.
I got it.
Okay, good.
Yep.
Jenith, you
Yes.
found it? Okay, Jonathan, you found it? Jonathan? Kula, did you find it?
Yeah.
Okay, Mariana. Richard, have you found it?
Yes, I found it.
Okay, it's this one, right? And then let's Tyra, are you there, Tyra?
Yeah.
Yeah, have you found it?
Yeah.
Okay, Yenchu.
Yes, I found it.
Okay, great. So let's take a look at this example. Of course, in the slide there are some discussions about the types of taxes, federal, state, and then excise tax, and different types of taxes. So let me briefly, address that. Um, tax can be on income, wealth, or consumption, right? Of course, everyone pays, everyone has to do income tax report, every, every year in April, but during this pandemic, last year it was like they extended it until like May something, right? And wealth tax is a tax on something like property, buildings, houses, buildings, land. Um and then income on no, that will be income, like capital gains income. Those will be on income, but wealth is basically something like on properties. Consumption, um, every time you buy anything, you pay taxes on that. That's called also excise tax. Um, uh, and then there is because we're not think about it. We're not paying taxes. We don't have to pay taxes double. State will also levy income tax, and the federal government, IRS, levies income tax. So there's federal income tax and state income tax. So if we have to pay them separately, then we will be taxed on the double. We'll be taxed on the double, right? So one of them, I mean, federal income tax will federal income tax will have, I mean, for federal income, because you have paid taxes on the federal income tax, your state income tax will have to have, federal income tax rate subtracted from the state income tax. so that state income tax will only reflect the net rate after federal income tax. So that is total effective tax rate. But it's not that difficult. You can we'll come back to this later. And we all know tax system is progressive. A personal income tax is progressive, but the corporate income tax is not really progressive. Progressive meaning, as your income goes up, the tax rate goes up. That's progressive. But in corporate income tax, it goes up and then down and goes up and then down. Now, it looks like a sine curve, right? It looks like a sine curve. Tax bracket is each segment of income, each bracket, each segment of income that is subject to certain tax rate. And marginal income tax, marginal tax rate and average tax rate, we're gonna talk about it as we do the example. So let's go to the example. Just let's go back to the Excel file. Now, this is a simplified, once again, this is a simplified example. We'll do a more extended example, a more realistic example later on, as we know, since 2018, the tax rate has changed. The tax rate changed in 2018. Trump administration basically introduced new tax rate. They passed it in the Congress, and Trump was saying that tax rate. Trump was saying as if he was lowering tax rate for average American or middle class Americans, but the reality is no. For middle income group, the tax rate didn't go down that much. I mean, it went down like went down nominally, but very minimal, like just 1%. But for high income group, the tax rate went down really, substantially. So it wasn't in the best interest of the middle class. It was mainly for the top 1%. Benefit was for top 1%. And so anyway, so our example is personal income, and let's say we have two people, a couple, Sue and Rob. Sue and Rob, their expected income. That means expected. E stands for expected, of course. And Y stands for income, right? Sue's expected income is 40K. Rob's expected income is 45K. And so their total income will be 85K. 85. But then that's not the old taxable income. That's not old taxable income, right? Taxable income is you arrive at taxable income after deductions and exemptions. And the deductions and exemptions are here. Retirement savings, 5% of the retirement savings, right, is can be deducted, and but the maximum savings is 4,000. So it's either 5% of your retirement savings, or 40K, 4K. If your 5% of your retirement savings is greater than 4,000, 4,000 will apply. Okay, And then there's personal exemption as 3,200 per person. And this is a couple, two people in this household. And if they are filing, jointly, is so there's going to be obviously 6,400, right? Personal exemption. Standard deduction is 10K. This standard deduction is just deduction given to everyone. So we'll need to deduct those items, right? So I'm gonna let me reflecting, actually the yellow highlight is reserved for the primary solution. So this is not primary solution. So let me just change the highlight to something else. That's too dark. Normally, when you print this out, you don't use dark colors because most likely you will be using black and white printer, and then if it is highlighted, highlighted by dark colors, it's going to come out as just black, so you can't read the numbers. So usually I would use something lighter, but let's say that's okay for now because we're not printing. And then these I will use something light. So retirement, we don't know what's 5% of their. We don't know what's 5% of their retirement savings. So do we know? Let's see. What I did here is, I will use minimum of either, whichever is the minimum, right? Whichever is the minimum, maximum saving 4,000 or 5% of their retirement savings. And I don't see what their retirement savings is. So let's, but B15. Oh, actually, this is a bit. Okay, without the narrative, I just assumed that they had separate, retirement savings. But okay, what this means is they allow 5% of their gross income, 5% of their gross income as retirement savings. So whether 5% of their gross income is whichever is smaller, we use that as their retirement savings deduction, right? Retirement savings deduction. So this is what it means. Minimum of the two, minimum of B2 times B15, which is B2, and this is B15. So we will know, by doing this, we'll know what it's going to be. Comma means I said and, so it's the minimum of the two. So whichever is smaller, it will be here. So apparently, 5% of 85,000 was greater than 4,000. Yeah, just by just by mental calculation, you can tell 10% of 85K is 8.5K. So half of that is greater than 4K. So it's going to automatically pick 4,000. Okay, and personal exemption will be 2 times that. Okay, and I don't like to normally I don't do this. I don't type in number. I mean, because this entails my discretionary judgment, right? I don't want anything to be, anything to depend on your discretion. We can do this. Instead, let me do this. I can use count command. And I will count number of people or, number of income, right? I can count these two. Anyway, what's important is whether I count the name of people or the cells that contain their income. It will count two rows, right? So there I have, right? I'll call that N. N, meaning number, right? So I'm gonna normally, I would align it center, because if you leave the labels, labels will be, all the text will be left aligned, and if it is just one symbol, right, one character, then sometimes, when you print it out, there's no grid line, and then it will be very confusing whether this, if it is like this, you don't know whether it is, the label for this data point or for something else. Because if you print it out, there's no grid line. You can also print out with the grid line, but then, and I would also, underline so that, it looks like a label. It's clear that it's saying it's the label. We have two people, so instead of, this way, if I have 3 people here or 4 people here, right? As I highlight all of that, it's going to automatically count the number of, people or number of source of income. Instead of entering manually 2 there, don't enter anything manually, right? You can what must be entered manually must be limited to only the input data, original input data, but all the logics, right? All the formula is the logic, basically. Formula is a logic. All the logic must be, other than, the logics, it must, the numbers, data must not be entered manually, right? So I will just point to that. And that way, in that case, if I have 3 people or 4 people in the household, and then it's going to automatically adjust, right? Without you actually, manually putting in 4 or 3 in there. Standard deduction. There you go. That's standard deduction per household. And then our taxable income is then, of course, then our taxable income will be this minus sum of all of these, right? So that's what I put in there. But, but I did it this way. Instead of, just B15 minus sum of all of that, I used, I entered maximum of the 2, maximum of either 0 or B minus sum of all of the deductions. Why? Well, this is to make this model universal, right? This is to make this model universal. Why? I mean, anyway, if there's any income, income will be positive. I mean, who has income below zero? Isn't it obvious? But this is just in case. Suppose you have negative income. Negative income. How can you have negative income? Well, a person, an individual, cannot have negative income, but businesses can have negative profit. You understand? Businesses can have negative profit. So in that case, right, if the business is, I mean, this model can be extended to corporate income tax calculation. So to allow for that, to allow for negative profit, negative income case, I have made it this way. So think about it. When businesses have negative taxable income, and if you just, without thinking, when you, it happens with the people who first, who met Excel for the first time in their lives. And then they think, Excel will do everything, accurately. No. Excel will execute. I mean, Excel will do everything correctly and accurately only as long as your formula is correct. Only as long as your formula is correct. So you cannot just, let Excel. You cannot just think the Excel will automatically take care of itself. No, you have to give Excel the correct command, and then Excel only executes your command. So if your formula is bad, Excel will produce, garbage. You understand? Huh? Your formula must be a good one. If your formula is garbage, then Excel will just produce garbage. Right? So some people who met Excel for the first time in their lives, they think, we'll just, but think about it. There are times when, taxable income for corporations, right, for businesses, can be negative. Of course, if they didn't make money, that much money, the revenue is relatively smaller than their expenses, then they will end up with, negative EBIT, right? First of all, they will end up with negative EBIT if their expenses are greater than their income. Their operating income or operating profit will be negative. And then if they have negative operating income, then they will first default on their interest payment, right? Remember, they will default on the interest payment. Okay, I will have to leave it like that, right? Go to the incomes. If this thing is less than the sum of the this and this, then this will be negative. If that is negative, then you can't pay this. If you can pay this, you default. I mean, they can, just like, Evergrande, it's been a talk of the town these days. Evergrande is, basically the problem is they have less operating income than the payments that they have to make. Then they are going to go bankrupt. If they will default, and if they don't extend, if the lenders or creditors don't extend the give them like a forgive them for one or two payments, then they go bankrupt.
So,
Yeah.
talk about the Evergrande, them defaulting. My question for
Okay. Hold on. I will answer your question after wrapping up my discussion. Okay. I will get back to you. So if they don't have, if this is negative, then they can't pay, and this is negative, it will pile up. But they have, then if they're after this, it will be EBT. EBT is taxable income. Taxable income is greater, negatively greater number, and then people who just met Excel for the first time, they will just um, uh, calculate the taxes and subtract taxes from um, EBT. If you subtract taxes from EBT, EBT is already negative number. Subtract taxes from a negative number, it will just be a bigger negative number. But think about it. Taxes are levied only when you have taxable income. If you have no taxable income, in other words, your EBT is zero, taxable income is zero, then there will be no taxes, right? Because they cannot, think about it, tax cannot be negative, right? I mean, tax is based on what? It's based on EBT, right? Tax is based on EBT. It's a percentage, some percentage of EBT. And EBT, taxable income, is already negative. Some percentage of taxable income will be also a negative number. And if you subtract a negative number from a negative number, it will be a bigger negative number, right? In other words, first of all, if taxable income is negative, uh, you cannot, there can be no taxes, right? So that is why um, if taxable income is negative, of course, for corporate tax, corporate income tax, it will be treated as it is loss. Clearly, it's loss, and the loss can be spread over, right? Loss can be spread over the past, like past 4 years and you can spread it over like 4 years into the past or 2 years and 2 years into the future, so that it can reduce your taxable income uh, from the past and also in the future, right? But that's why here's that zero. So either the maximum of the two, either zero or this minus the deductions, right? And if it happens to be negative, then it will be zero, will be picked automatically, so that you won't have any taxable income. Yes, back to the question of someone was asking about Evergrande.
me, Professor.
Yeah, go ahead.
So, from what I have read, but I haven't been paying attention to the stock market lately, is that Evergrande, since they default payments, they kind of crashed the market. Not crashed the market, but the market did see a drop. So, is that true? If it is true, then what did I? So you're telling me if a bank does not receive a payment, it affects the whole stock market in general?
Yeah, it can, but the effect will be limited. Um, uh, it depends on. It's like this. Basically, that Evergrande, which is a property developer mainly, I believe, from what I read, they are not only into uh, property development, but they are also they have branched out into many other sectors, but their primary business is property development. So obviously, they must have, most property developers, start with the loans. I mean, there's something called project financing, but in project financing, uh, those who are, it's like, private equity funds. Uh, uh, you fund it by investment from, those who want to take part into this part in those who want to take part in this project. So they are basically investors. That's project financing. But I don't know how far this type of project financing is um, practiced in China. Otherwise, if it isn't by project financing, they will have to get a loan, and the banks will lend easily to property developers because um, there will be collaterals. I mean, lending money to uh, uh, property property developers. There will be buildings, houses, built by developer, and they can be put up as collateral, right? Um, so banks are lending, and another thing is that the in China, my understanding is that most of the banks are state owned. It's not private, state owned. So this is one thing that may mitigate the effect of spreading spreading this crisis globally. It will mitigate. If it is if the banks are mostly private, what they would do, I believe they would do exactly the same thing as what they did in 2008 financial crisis. Um, if the banks are in China are private. What they did in 2008 was, banks lended to subprime borrowers, and one. So if the bank lends money, let's say subprime borrower borrowed, $1 million. Uh, that's mortgage, and the bank lended to 10 subprime borrowers. So, and each of these subprime borrowers bought uh, 10 houses, and they were all $1 million houses. And of course, you have to make a down payment, because without the down payment, you don't have any stake in the house, right? If the house is $1 million, if that house that you want to buy is $1 million, then if the bank lends 100% of that money, I mean, what is the basis for claiming ownership on the house? Huh? The subprime borrower didn't put in anything, and 100% of the money came from the bank. So why should the bank have this person there? The bank can just kick out this person and own the house right away. I mean, straightforward, own the house and rent a house to this person, right? Does that make sense? So that's why there should be a down payment. I mean, if you make even 1% down payment, right? I mean, that's what happened during the subprime mortgage period, right? The era of subprime mortgage was like early 2000, like 2001 through 2006, 7. During those days, subprime mortgage was made. The subprime mortgage loan was made to the people who didn't qualify at all. But with a lot of punitive clauses. In other words, subprime category borrowers could not got the adjustable mortgage rate, which means just the flexible rate, flexible interest rate. So if the market interest rate goes up, their interest rate on their mortgage goes up. So this is what happened, later on. But the idea is, if you borrow just 1 million and buy a $1 million house, then you don't have any stake in it. So it's not. I mean, the bank will just own it outright and just kick you out. I mean, you don't have any, and maybe they can rent it to you. I mean, what? No. So theoretically, you have to have a down payment. But back in during the subprime days, they could even make a 1% down payment. Still, even if you have 1% down payment, then 99% is the loan, and still you have a stake in it. So it could be you can own the house. Of course, the title is not with you until you pay off the mortgage. The title is with the bank, but you can own the house. And once they loan the money, the bank should stop there. I mean, when they loan the money, then the house was put up as collateral. The house is collateralized. A bank can lend money even to people with such low credit score, mediocre credit score, because the house is automatically collateralized. So they can repossess it anytime. They can repossess it if they default. They can repossess it anytime. So this is a win-win situation for the bank, because if the borrower defaults, they can repossess the house and resell it in the market, and then they can recover their 1 million. And until then, they have collected, they have received all the payments. So nothing to lose for the banks. The banks had all the incentives to lend even to the subprime category, subprime borrowers. And then the bank should have stopped there. The house is collateralized, so if they default, But then if they made 10 loans like this, that's like $10 million, right? That means, bank is without this $10 million now. They had $10 million, they loaned it, so they don't have $10 million. But so what the bank, that means, they are $10 million less to lend out, right? Makes sense. They have $10 million less to lend out. Then what they did was using these, they sold the securities. They sold the securities. In other words, they sold bonds, something like bonds, right? They sold bonds based on these, collaterals. So that's called, mortgage-backed securities. Mortgage-backed securities. These bonds are backed by this mortgage. In other words, mortgage payment comes in every month. So by selling bonds, the banks will get $10 million back, right? They are selling bonds for $10 million. Whoever buys the bond will pay, 10 million, right? It could be, 10 buyers. Each buyer can, each bondholder can buy $1 million worth of bonds each, or it could be, 1 million. Each bond, the face value of the bond is like $1,000. So approximately, there could be 10,000 buyers who buy bonds. But no matter what, by selling bonds backed by these, collaterals, right? The banks can get $10 million into their reserves, right? Because think about it. Previously, before lending out money, they had, reserves, and part of the reserves was this $10 million. If they had total of $30 million in reserves, 10 million is now out, right? 10 million is gone into a mortgage loan. So their reserve is only 20 million now. With $20 million, they can only make loans up to $20 million, right? But and remember, banks make money by lending money. Banks make money by lending money. They cannot make money by taking deposits, because if they take deposit, they will have to pay interest. But by lending money, they will receive interest. So they make money by lending money. So they want to maximize lending, right? So if their reserve is now after making loan, their reserve is low now. They can make only loans up to only 20 million. So by selling bonds, now their reserve is 30 million. Now they can make a $10 million more loan, right? They can make $30 million loan. So that's why they sold these mortgage-backed securities. Mortgage-backed securities are, literally, I said it will be it's in the form of the bond because they sold. So if the bond, this bond is secured because there is mortgage. I mean, in case first of all, the homeowners will make payment. Payment is basically every month, monthly payment, and monthly payment will include both interest and principal. So from this interest and principal that they receive from the homeowners, then they can pay the interest to the bond holders. So as long as there's payment coming in from the homeowners, then they can service this debt. They can pay the interest to their bond holders, and the bond pays only interest until the maturity. Okay, so if the maturity of this bond is 30 years, and if the mortgage is also 30 years, and by the year 30, all the principal of the mortgage has been paid, right? So, and in the meantime, interest has been paid to the bondholders, and at the end of year 30, with the principal of the mortgage fully paid, they can pay off the bondholders. So this is secure. Up to this point is secure. But then suddenly, interest rate went up. What happened? So as the interest rate went up, all these subprime mortgage home buyers, they default. They cannot. So then the bank, what does the bank do? The bank will repossess these 10 homes and they will put it on the market to recover the principal. But then what happens? If it is just one or two houses repossessed, and that would be a normal situation. Under normal circumstances, one or two houses being repossessed won't have difficulty getting sold, right? And they can recover the full value of the house. And then they can pay, with that, they can pay off the bondholders. I mean, but then there are massive, I mean, this happened on a massive scale. So there was a massive, number of repossessed properties, and they are all put back on the resale market. What's going to happen to the price of all these, repossessed houses? Anyone? What's going to happen to the repossessed price of the repossessed houses? Isn't that easy to imagine that isn't it easy to reason that the price of all these repossessed homes will drop drastically because there's a massive sell-off, right? There's a massive supply of repossessed homes, then they cannot sell at their full value. And suppose all these houses lose value by 50%. So they are $1 million homes, but they are selling for $500,000 now. So even if they sell, they can only recover 50%. The bank, by recovering only 50%, cannot meet the obligation to the bondholders, right? They sold bond for 10 million. Now they have only 5 million. With 5 million, they cannot pay the bond. Of course, the bond will mature in 30 years, so it doesn't have to be right away, but they only recovered 50%. So even in 30 years or in 10 years or even 5 years, when the bond matures, how will they come up with the remaining 5 million, right? The bank has sustained loss of 5 million already here, and when the bond becomes due, the bank will have difficulty. The bank will go bankrupt if they cannot come up with the other 50%. The bank will go bankrupt. And it's not only that. What made it more complicated was that these mortgage-backed securities are some investment investment bank plus asset management firms, investment bank as well as asset management firms like Goldman Sachs, J.P. Morgan, Lehman Brothers, Bear Stearns. What they did was they bought these. They were the main. Think about it. When banks bought these mortgage-backed securities, right? When banks sold these mortgage-backed securities, right? Who would be the likeliest buyer? Likeliest, it's not individuals. It's not individual investors. It's the institutional investors like J.P. Morgan, Goldman Sachs, Lehman Brothers. They are the ones, and insurance companies. They bought these, mortgage-backed securities, and what they did was buying something means your cash reserves go down. If you buy something, you have to make the payment, so cash reserve goes down, right? They don't. In other words, their current assets go down. Current asset side go down, right? Cash, not the current asset. Cash goes down, but the current asset will remain the same because if they bought $10 million of bonds, the mortgage-backed securities, cash goes down by 10 million, but the assets, right? These are bonds. Bonds increase by bond holding, stocks and bond holding in the current asset side will go up by 10 million. So it will be the same thing, but cash goes down by 10 million. But Goldman Sachs, all these investment banks, what they did was, instead of leaving their cash balance go down by 10 million, what they did was they sliced and diced all these mortgage-backed securities. Why? Because first of all, mortgage-backed securities are not coming from only the subprime borrowers. There are mortgage-backed securities that originated from very solid, high quality borrowers. There are borrowers with very high credit rating, but there are home buyers with very high credit score, and they borrowed money. So the mortgage-backed security that originates from a low risk, high quality borrower. This type of mortgage-backed security is rated AAA. They are very high quality, low risk, high credit worthy mortgage-backed security. I'll just call it bond because it's I get tongue-tied by repeating the word repeatedly. There's high-class, high-rated bond, AAA bond, but the bonds originating from the loan made to subprime borrowers, they will be very low quality, like C or even triple D, very low quality. And Goldman Sachs, Lehman Brothers, J.P. Morgan, they have all these bonds, right? Mortgage-backed securities. Because they pay interest, right? And they, but because they paid 10 million for these bonds, their cash decreased by 10 million. So they thought about a way of not decreasing their cash balance. But if they sell this back, if they sell this again, then they can get 10 million back into their cash reserve, cash balance. So what did they do? But then they sliced and diced all these different bonds of different credit ratings. So then they bundled it up, right? So in this bundle, and they call that bundle CDI, collateralized debt instrument, okay? And then this bundle is called CDI, but then this bundle is very questionable. It's a big question mark. What is the risk? I mean, previously the bonds were there. Some mortgage borrower had AAA, excellent credit rating. Some AA, some single A. You could tell what their risk level was. But this CDI is all sort of like like a sausage coming out of the grinder. You can put high quality meat or a low quality meat, whatever. You put it into this grinder and comes out the ground beef, right? You understand? And you put that, that's basically sausage. I mean, you whatever you call it, ground beef or sausage. Or it could be beef, it could be pork, it could be chicken, it could be turkey. You all put it into the this grinder, meat grinder, and comes out just the ground meat. And how do you know what this ground meat is? I mean, some of that is beef, some of that is pork, some of them is turkey, some of them, some of that is chicken, and it's not even purely meat. Sometimes it could be the organs, like liver, all those sometimes snouts, sometimes hooves, whatever. Everything goes in there, comes out this ground meat. So you don't know the credit rating of this CDI. It's very opaque, right? And it's opaque. It's not clear. It's not transparent. So there's no knowing what the credit rating of these bundle is. So what they thought about was they started something called credit default swap. What is a credit default swap? Credit default swap is an insurance. So they pay insurance premium to insurance company, and insurance company will pay for this CDI in case the CDI defaults. And the insurance company like AIG, they accept it. But like if they, by paying 1% of the CDI value, or I don't know, maybe 1%, 5%, whatever, that's the insurance premium. And then the insurance company took on that CDI, credit default swap. And once with the credit default swap, because the insurance company is backing it up, this CDI suddenly got a triple A rating, triple A. Now, insurance company won't fail. Everything is like, not if everything happens, little by little, gradually, uh, insurance company will never go bankrupt. Now, think about it. You don't get into an accident every day. You don't get into a car accident every day, right? Your car doesn't get totaled every day. And that's why you can, have car insurance, because you pay insurance premium as all your life. As long as you have a car, you'll pay insurance premium. But as long as you don't get into an accident, you don't use insurance. So the insurance company gets a lot of cash inflow, but they hardly have cash outflow. How often do you use your car insurance? Huh? Unless it is, a serious accident. And in a serious accident, your car is totaled completely. So, it should be sent to the junkyard. It doesn't even, and then you gotta buy a new car. And otherwise, minor accidents like minor a fender bender, or some scuffs, scuffs, scratches and scuffs and dents, dents. You don't use insurance because your insurance premium goes up, so you will just, pay out of your own pocket to repair it. So you hardly use insurance, but you pay insurance premium, every month all your life. And if you ever use your insurance, that's just once or twice in your life. So that's why insurance, and since this is the reality, insurance companies can continue. They can go on. But if everyone gets into accident every week or every month, and everyone's car gets totaled every month, there can be no insurance company. They will all go bankrupt, or the premium will have to go up very high. Right? Does that make sense?
Yeah.
So the insurance company's mentality, their mindset is, what are the chances of these CDIs go, bankrupt? CDIs default. What are the chances of these CDIs default? If they default, even if they default, it will be just one or two. We can handle it, and we take, insurance premium for that. So that happened. But this is the culprit of the financial crisis, because back in 2008, these CDIs went bad, and then so the insurance companies also, on a massive scale, it happened, and the insurance companies were in trouble too. So think about it. Subprime mortgage crisis broke out. Subprime mortgage crisis broke out in September of 2007, and in just over a span of 6 months, Lehman Brothers were in trouble. Why? Because think about it. Lehman Brothers sold a lot of CDIs. They first they bought these bonds from the banks, right? The mortgage-backed securities, and as I said, they should have stopped there. The bank should have stopped there. Not selling bonds based on that mortgage-backed securities. I mean, even if they did, okay, they should have stopped there. They shouldn't have sliced it. The investment banks shouldn't have sliced and diced those different mortgage-backed securities and bundled up. In other words, CDI, collateralized debt instruments, were the main culprit of the financial crisis, and the credit default swap was accomplice, right? And then with the massive default, massive repossession of houses, right? Then the banks were in trouble. They cannot recover the principal of the loan, and then so they cannot pay back the bondholders, like investment banks, Lehman Brothers, who bought these bonds. The banks were in trouble. Lehman Brothers, are in trouble as well because these, they sold the CDIs, but these CDIs were already originally backed by all these, mortgages. Mortgages got all halved, all these mortgage loans lost value by, mortgage loans could not be, 50% of that could not be recovered. I don't know exactly. It's just an example. It could have been, 70%, or it could have been 60%, or whatever, 30%. But that they are called toxic assets. Why toxic assets? Because 100% of the principal cannot be recovered. CDIs are called derivatives. Also, credit default swap, credit default swap, CDS. They are all called derivatives. These derivatives, by association, in chain reaction, they all lost value. So they all became toxic asset, right? And so Lehman Brothers first, defaulted. They cannot, the CDIs that are that need to be paid couldn't be paid. Lehman was in trouble, and what they did was they bailed out Lehman, but they didn't not by injecting money, but they negotiated a deal, sale of Lehman Brothers to Bank of America. Bank of America got Lehman Brothers on 20 cents for 20 cents on a dollar. So in other words, the stock value of Lehman Brothers were, Bank of America acquired Lehman Brothers at 20% of its stock value. Okay, and then came the Bear Stearns. Bear Stearns was the next, over the span of 6 months, 6 months to 1 year, this all happened. Bear Stearns, the same thing happened to Bear Stearns, and they let Bear Stearns, go down. They let Bear Stearns go down. And then came AIG. AIG is an insurance company, so they held a lot of credit default swaps. And when CDIs went bad, they had to pay those CDI values because they were the insurers. And so they didn't have money to so they went bankrupt. And then they got bailed out. AIG got bailed out. Lehman Brothers got bailed out. I mean, it wasn't a direct bailout, but they got, it was acquired by Bank of America. So people working for AIG, not all of them, but at least majority of them kept their jobs, I think. Bear Stearns went down. Now, think about it. This was possible because U.S. financial system was the most advanced financial system in the world, and then there were derivatives. These were basically contraptions of the investment banks. They came up with the idea of CDI. I mean, these new inventions came out, but these inventions were basically they didn't do anything. These new inventions like CDIs, credit default swaps, they didn't reduce risk at all. It just moved the risks around. It just transferred the risk from one entity to another, right? It didn't reduce the risk. But in the U.S. Financial system, there are many investors, individual or institutional, domestic and foreign, individual and institutional, domestic and foreign. So it could, because there are many foreign investors who are buying CDIs, right? And the CDIs are backed up by the CDS, credit default swap. So almost, repackaged as if they were AAA, right? They were packaged and repackaged. They were diced and sliced, and it's a sausage machine. Sausage came out, all kinds of meat or non-meat, right? Organs or excess parts of the animal went into the sausage machine and came out as sausage and repackaged as premium beef, right? So it's like, if this is not premium beef, AIG will, right? AIG is the insurer. You understand? That's that's credit default swap. If this is not premium beef, or they wouldn't say beef, but premium meat, AIG will pay for that. So globally, investors bought it. And then when the financial crisis happened, it could spread globally because U.S. financial market is global. Now, Evergrande, back to Evergrande. So I told you, Evergrande most likely borrowed funds from domestic Chinese banks, right? Chinese banks, and I told you Chinese banks are mostly state-run. And so state-run Chinese banks, will they maybe they have done something like, they sold, bonds like mortgage-backed securities too. But how globalized is the Chinese, financial market? Will there be a lot of U.S. investors, European investors, South Korean investors, Japanese investors, institutional? When I say investors, I mean it will be institutional investors. Investor sounds like a person. No. There can be individual investor, but institutional investor. Globally, it's institutional investors. Hedge funds, and asset management companies. Asset management companies are also sometimes, investment banks as well. They are. So how many of the global financiers really, bought? If Chinese banks issued something like mortgage-backed securities, if it is held mainly by Chinese investors or regional, like Singapore invests a lot in China. I know Singapore, Hong Kong, or Thailand mainly. If it is within the region, no matter, and I don't think state-owned banks would. And then within China. China must also, they must have investment banks and asset management firms. And if Chinese asset management firms and investment banks created something like CDI, right? Like back in 2008, if they created CDI and with the credit default swap added to that and rebundled it, repackaged it as AAA, right? And sold it to other institutional investors, and if it was global, then it could have a global effect, right? It can have a global impact, but I don't think it will have a global effect. Most of those, and even knowing that the same thing caused 2008 financial crisis, I don't think Chinese, investment banks or asset management firms created CDIs, coupled it with, credit default swap. I don't think they did it. They replicated what happened, what caused, 2008 financial crisis. And even if they did, the impact would be rather regional. But I don't know because I don't have the input data. We know I have the. We can have a model or formula. The formula has a couple of variables. One, how much was the debt of the variable number one. How much was the debt this Evergrande owes the lenders, the domestic banks. Two, second variable, how much of these mortgage-backed securities were sold by the banks, right? Three, variable number three, how much CDIs were created based on these mortgage-backed securities. Variable number four, how much credit default swaps were sold, right? With these CDIs. In other words, if I have the input data for these four variables, then we can estimate how much impact it has, right? Whether, and of course, whether it was the buyers were global or not, right? Buyers of those derivatives, CDIs, were global or not, right? And if globally, if we have these input data, then we can tell what's going to be the impact, and whether the impact will be global or regional or just national. It will certainly be more than national. At least like Southeast Asia will be affected, and to some limited extent, East Asia, like Northeast, South Korea, Japan, can be affected. But Evergrande is not bankrupt yet. But if it goes bankrupt, it will have clearly at least regional ripple effect. But again, we can construct a model or formula to estimate the impact. But then these variables, we need the data for this input variable. And if we have this input variable, then we can estimate it. Okay. All righty. That took a lot of time. That took a big chunk of time. But at least does that help to understand? Does that help understanding? Does that help your understanding of the Evergrande situation?
It does.
Okay. All right. At least one person. It helped one person. At least out of 11, was it? Were there 11 or 10? I'm down to 9 people. This is very discouraging.
What happened?
Hmm?
I said, what
Yeah.
happened to the number?
What? Huh?
I said, what happened to the number of people that were in the class?
I don't know. They skipped. Right? Let me see. Original India discussion board, there are 12 people, 12, except myself. So out of 12, 3 skipped, right? 3 has skipped. And on the roster, there are like 21, 22 people on the roster, and hardly, like about 10 people hardly come to the collaboration, hardly report attendance. It's all to your own detriment. You have to understand it's to your own detriment. Because at the end of the semester you have participation point and attendance point. If you have zero for that, then it will cut deeply into your semester grade, because 10 row points out of 100 It's a big deal. It could be more than 10. I mean, if your participation is, participation point is, significant, then you could have like 24 participation point, and that will be total of 30 points, including your attendance points, and then adding up out of your total of 100. I mean, if you did, it can even make up for if you got 0 in first exam. If you got 0 in the first exam, and first like midterm is 25%. Final is 25%. If you got 0 in the midterm, these 30 points can even make up for more than make up for the midterm, right? And people don't realize that. Those who are skipping class don't realize that.
Professor, quick question.
Yeah.
Do we need a book for this class, a textbook, or no?
Yes, you need the textbook because I don't use a lot of verbiage. I don't but textbook will. Some people say I need to read I need the verbiage. For those people who need verbiage, yeah, they need textbook. But if you don't
Okay,
need
where's
much
the link for the
verbiage,
textbook?
if you don't need much verbiage, you won't need textbook that much. Okay, but there is textbook. I don't know if it is in the bookstore because it's custom made. It's a custom book, and when there is sufficient order, they will print it. When there is not sufficient order, they may not print it. And even if there is not sufficient order, they can print it.
I was gonna say there's like only one way you can get the textbook. I think I found it on one website. I couldn't find it anywhere else. I could find out the link and then just put it in our WhatsApp group.
You mean the custom book or the regular textbook?
Yes, the custom book, the one that you put on the syllabus.
As I said, you can have two options. One is the custom book or the
Professor, quick question.
Let me finish up first. Let me hear me out. You can buy 5th edition or above of the regular edition, but the book is already into the 10th edition or something like that, or 11th edition. So, but it has to be above 5th edition or above. So you can find many good bargains of the 5th edition on Amazon, right? Because it's an old book, right? But it has to be 5th edition or above, right? It's going to be difficult to find even the 5th edition. Yes, what was the question?
I was just going to ask about late homework. I know I forgot to submit it yesterday, but I got
No. It's due today. You're not late. You're not late yet. Read it again. It's today, 11:59 p.m. today. The deadline is 11:59 p.m. Yeah, you're not late. Oh, you're welcome. So now I want to wrap this up because we're already running out of time. So maybe we can't. I just want to do this. Now I'm gonna have to. So these are primary solution. And in personal income tax, there are brackets. It's not like you're paying. There's a 10% tax bracket, 15%, 25%, and like 28%, 30%. I mean, there are in reality there are like 5 brackets or 7 brackets, and in each bracket, you pay. For example, 10%, you pay 10% on the income first up to first $14,600, right? In other words, just because their taxable income is $64,600, $64,600 would fall into this this bracket, this range, but so you might think, oh, I paid 25% of 64,600. No, it's not like that. You break it down by these brackets. So for first 14,600, you pay 10%. And then the next bracket, 14,600, above 14,600 and up to 59,000, you pay 15% of that bracket, of that segment, right? Or of that layer of your income. And then above 59,000 for something, and up to 119 something, right? You pay 25% for that bracket or for that segment. So in reality, you don't pay. This is only your top tax rate. If your income falls into this bracket, this is only your top tax rate. It doesn't mean that you paid at totally at 25%. You understand? And then marginal tax rate is, so this is the top tax rate for this couple, but if this couple's income goes on further, then their top tax rate will be different. And their marginal tax rate is, so if they made more than this, let's say they made more than this, their taxable income is 19,953, right? Or 55, let's say 55. Then they have a bracket that falls above this. Let's say it is 25% here. Let's say it's 28%. Right? Let's say it's 28%. And their income, and between $5 will be subject to, if their taxable income is, 119,955, then above this, right, this $5, right, the portion above that, the $5 will be subject to 28% rate, right? You understand? So you're not paying at the top rate. You're paying at that specified rate for each tax bracket. So in this example, here, the amount that's tax amount, the tax dollars that will be at 10%. First of all, so our question is, the first layer of their taxable income is up to 14,600, and they have that. So 14,600 will be subject to 10%. But I did it this way. First of all, B6 is this tax rate, right? 10% times minimum of the two. B19 is their taxable income, and E6. Now, think about it. What if so this is to make the model applicable to universally, to make it universally applicable so that it can be applied under any taxable income situation. So if their taxable income, what if their taxable income is not even 14,600? What if it was just 13,000? Then you just pay 10% of 13,000. So that's why minimum of the two, right? Whichever is smaller. Okay. Then Excel will automatically pick whichever is smaller. And in this case, this is smaller, right? So it will multiply 10% to that. Okay. And then next bracket will be above if. So if command comes in, here comes into play. It's very handy, I've been telling you. So if our taxable income, which is B19, if our taxable income is greater than E6, yeah, of course. If our this is the scenario where our taxable income has is above this. So if it is above that, then we have two questions. One, so is it greater than? We will apply 15%. We will apply 15% to the minimum of the taxable income and the difference between the next upper bound and the lower bound, right? So what that means is if our taxable income is if our taxable income is greater than the upper bound, if our taxable income is if our taxable income is less than the upper bound, right? Less than the upper bound, Excel will automatically pick our taxable income and subtract lower bound. So if our taxable income was like $40,000, $40,000 is lower than the upper bound. So Excel will pick
Professor.
40,000 and subtract this, and only that portion will be multiplied by 15%. Otherwise, we will have that means our taxable income is greater than this. So if it is greater than this, then our bracket for 15% is the difference between this and this.
Professor.
So it's gonna yeah.
I don't mean to interrupt you, but isn't class until 12:15? I've got some obligations.
I'm sorry. I'm sorry. I'm sorry. You reminded me. I thought it was until 12:30. I'm sorry. So the class is already dismissed. I'm sorry.
I hate to be that guy, but like I said, I have some obligations to.
Yeah. I'm sorry about that. 12:15. So okay, the class is dismissed. I guess we'll have to continue this in the next class. Okay? Next class. All righty. But you got the logic. We'll go back. We'll come back to this next time. Okay? Sorry for reminding me.
Also,
you guys owe me 15 minutes. You guys owe me 15 minutes next time. Okay? You guys, although it's my fault. But, you guys
once again, sorry about that.
No problem. I appreciate it. Thank you for reminding me. And I already exceeded even 5 minutes. Even if I thought it was until 12:30. All right, guys. I'll take care, and I will see you guys on next Saturday.
Professor, before you go, I submitted the assignment yesterday, but
I received it.
That's the wrong one.
Look, I received it
yesterday at 11:59.
What?
So I kind of rushed through it and submitted it.
Oh, you want to resubmit it? Is that what you're saying?
Yeah, I'm gonna send you a new one.
Okay, I will delete whatever I received yesterday. Yeah. Okay?
Because I thought it was due yesterday. That's why I.
No. Yeah. But I will delete. I'm telling you, I will delete what I received from you yesterday. Okay?
Okay. Sounds
all righty.
good.
All righty. I'll see you guys. All right. Take care, everyone.
Thank you.
Take care.
Okay. Bye.
All righty. All right. I'm gonna stop sharing. Stop it.